Okay, here we go. Chapter 8, I believe, in your book, the relationship between risk and return, and sort of how Wall Street looks at what price stocks should be trading at. Okay? And so before we really dive into this chapter, I want to take a minute and rewind and try to relate the things that we've already done in this class to the question of stock valuing, right? And so the first thing, I want to go way back, all the way back to chapter 3, the beginning of our time value of money stuff, right? And if we kind of, that was pretty technical and a new concept for you, and there were a lot of examples, but let's just kind of rewind a little bit and think about what that chapter was about. And the idea of interest is really, not only is it the interest that is gained on an investment, but it's really how we're introduced to the idea of a required return for an investment. For instance, if I give you $1,000 today and you give me $1,100 next year, I get a 10% return on that investment of $1,000. Right? We call that return interest in the case of loans, but that's really what it is. I'm an investor, and I think you're a good bet, and so I'm going to give you $1,000, and you're going to give me 10% more than that next year. And then if we look at bond valuations, let's see if we can get our heads around bond valuations in the same kind of way, right? So remember, when we looked at valuing bonds are sold in the market at a certain price, and they're priced as the present value of future cash flows, right? And so a bond is sold, with that sort of ticket looking thing. It's got a price on it, and on that bond pricing is the yield to maturity, which gives you the relationship between today's investment of purchasing a bond and the cash flows that you're going to get over the period of the life of the bond, right? And so if we try to pull this example again, if we buy $1,000 1-year zero coupon bond today for $909, and then I get that $1,000 back next year, that's also a 10% return, right? So the return on a bond is the yield to maturity. The return on a loan is interest. But there's still, returns on investments, right? And the thing is that the price of the bond that you purchase sort of implies the yield, right? So they sell you a bond. It's sold at a certain rate. They tell you what the yield is, but if you went through the process of doing the discounted cash flows, you would come up with precisely the price that is given on the bond, as we saw in numerous examples from the last module, right? So now let's start thinking about trying to expand that concept to valuing stock. So how much should a stock sell for, right? Because remember, if we're looking at how much a bond sells for, we have a yield there that's implied, or that's actually given, right? But with a stock, right, we do have some models for valuing stock which are comparable, analogous to the bond valuation models. These are dividend models on stock, and they price stocks similarly to the way that bonds are priced as the present value of future cash flows associated with the purchase of that stock. But those models fail. They are not broadly applicable for a couple of different reasons. And actually, if we go over here to the stock chapter, I'll just sort of, here's stock valuation section, and here's the shortcomings of the dividend model. And they fail. And so they give you, in the book, they give you some examples of how they fail and why they fail and where they fail. But the primary reason that they fail, well, there's a couple of reasons, but one of them is that the future cash flows, the sale price of the stock, is unknown at the date of purchase. Right? When you buy a bond, you know what that terminal cash flow is going to be. With a stock, you don't know. You don't know how long you're going to hold it. So you don't even know how long to discount it for. And so, those dividend models that try to set up stock valuation in the same way that bonds are valued, they just don't work. They just don't work. We need a model that'll get us to the yield. And that'll allow us to estimate the prices. Okay, because remember, the price of a bond incorporates the yield. The price of a stock should also incorporate the yield on the stock, or the return on the stock. And so I'm literally going to read a paragraph out of this book out loud for you. It says, apparently what we need is a pricing model that is more inclusive than the dividend model, one that can estimate expected returns for stock without the need for a stable dividend history. And so we use the capital asset pricing model. We will introduce an application of this model called the security market line that will be more inclusive and will provide expected returns for companies based on their risk, the premium for taking on the risk, and the reward for waiting, and not on their historic dividend patterns. Right? So that's basically the setup to get us ready to go into Chapter 8. Okay, so I'm going to stop this one here, brief video, and we'll move on into the meat of Chapter 8 in a sec.